Good morning and welcome to the Coinbase Institutional podcast. It is Tuesday, 7th of November. And a fun fact for you, did you know that it was exactly 2 years ago, November 7th, 2021, where BTC hit an all-time high, traded as high as 68,789 on Coinbase. Wow, a lot has happened since then. Greg David, I think it's probably fair to say that we're not going to see an all-time high in 2023, but can I get a pulse check here? We've had a good couple of weeks. How are you guys feeling about the market?
Yeah, I think we're feeling pretty good, Ben. We're seeing increased volumes along with increased prices. So, both very healthy for the market. I tend to agree. We're not going to see new highs this year, but 2024, given the tailwinds of the ETF, the halvening, and possible rate cuts, we could see something there. So.
Yep. It seems like we're getting to levels where the short gammas are kind of crowding around. So I think that at this point, if it does seem like it breaks some of those key levels, we can see another period of upside. But I wouldn't be surprised to see it kind of just at least grind around these levels for the time being.
Okay, so I didn't hear an all-time high there. I heard it's feeling okay, but we'll take that for the time being. This year's been a tough year, so we'll certainly take that. So in this episode, we're very excited to have Tushar Jain as our special guest. Tushar is a managing partner at Multicoin Capital, a thesis-driven investment firm that invests in cryptocurrencies, tokens, and blockchain companies. He is going to be sharing his insights on Solana and the recent Breakpoint conference. I have to say, there are a few investors in the space that know Solana quite as well as Tushar, so super excited to get into that. Also on the agenda, we've got all the latest that you need to know around the news, the macro flows that we're seeing, and Web3. But before we get into it, some quick housekeeping. If you're watching on YouTube, don't forget to scan that QR code to check out David and the team's fantastic research. And if you're listening on podcast, that link will be in the show notes. And no matter what platform you are consuming this on, don't forget to like and subscribe, because that's how others hear about the fantastic podcast and content we're putting together for you. But without further ado, Tushar, welcome to the podcast. Thank you for joining us.
Hey, Ben. Great to be here. Thanks for having me.
Of course, an absolute pleasure. So you, as mentioned, are the managing partner along with Kyle for Multicoin Capital. You launched in June 2017. And before that, you were a founder of a healthcare tech company. You are one of the biggest and well-known funds in the space. So I'm sure most listeners will already know who Multicoin are. So we'll get right into it. As mentioned at the start, you're a thesis-driven investment firm. I've always admired how on social media and in other forums, you're not afraid to go against the crowd. So can you maybe just explain to us a little better, like, what does thesis-driven mean to you?
I think there are several styles of investing that can work for different market participants. For us, what thesis-driven means is we look at the qualitative aspects of our investments, and we try to focus on what do we actually know from first principles. We look for differentiated views from the market because we think the only way to outperform is to be contrarian and be right. And we specifically try to think about how a market structure will evolve and what does the capital market today think about that market structure, and why do we think we know better? Or how do we think about market size evolution for something, and how is the capital market pricing that today, and why do we think we know better? So we really focus on some of those fundamental first principles type investment underwriting processes.
Perfect. So we're gonna get into that in a big way in a second when we talk around Solana. But before we do, obviously you've just got back from Amsterdam. There was the kind of the main Solana developer conference, Breakpoint. How was it? Like, what was the vibe like? What was the energy good?
The energy was great. In fact, if you told me after Breakpoint 2022, the energy was high at the event, but on the plane ride back is when everyone got the news about FTX and everything going on there. And to say that a year later that the energy would have been as high as it was and the attendance would have been as high as it was is actually a phenomenal testament to the staying power of the Solana developer community. So I think everyone was quite enthused by that. And I think there was a clear sense of, hey, we're not going anywhere. And we really fundamentally believe in this. I think the best way to forge a community is through shared hardship. And the Solana community has had that in spades over the last year. So I think this conference was a real testament to how strong the community is.
Yeah, I would say, and it's a compliment, that the Solana community is probably quite gritty in the way that Angela Duckworth talks about it in her book. It's been a challenging sort of 12 months, I'm sure, for the whole community, but they've stuck through it and they're still around. I'm curious, any key takeaways, if you were to kind of summarize it in like the main things that you took away from the conference, apart from obviously the energy being positive, what would they be?
Some of the biggest things that I noticed were, one, Firedancer being on testnet is a pretty substantial milestone. I think that the team that's building Firedancer is uniquely qualified to build low latency, high performance applications, having worked at Jump Trading, one of the main market makers or trading firms out there in the world. So very excited to see that happening, and seeing the testnet results of it, I think will be very meaningful for the Solana network. I was also quite happy to see the focus on payments over Solana. As listeners probably know, Visa recently announced that they're working to settle transactions on Solana along with some of their merchant acquirer partners. And there were several startups that we saw building really smooth payment flows on Solana, because it's just so fast. It feels like a Web 2 payment, but confirms on a blockchain. So I was very excited about that. And then last but not least, I was excited about DePin, or decentralized physical infrastructure networks, things like Helium, HiveMapper, Render, that are all building on Solana. And it has really become apparent that Solana is the home for DePin as a sector. And it's a sector that I'm particularly excited about going into the next 2 years.
So, Tushar, it seems like there doesn't seem to be as much talk around the Solana Labs launch of the version 1.16 client, which actually does a lot, right? It actually reduces the hardware restrictions. It's going to introduce native privacy on the chain. Is there anyone who is discussing what those things will do to the network?
Yeah, absolutely. There's several features in there, especially their new token standard, which has privacy enabled, which I think is quite compelling. But honestly, the focus of the community is really on what's going on with Firedancer and the incredible performance gains that it gives. So that's kind of outshined the release of the new validator client from Solana Labs.
So let's kind of talk about that, because it seems like that's going to increase the throughput to like 1 million transactions per second, or if you want to look at it in like actual data processing terms, like 1,250 megabytes per second, which is pretty outstanding. I mean, what about all the all other kind of clients kind of being built? Like, why is there so much focus on Firedancer in particular?
The focus on Firedancer is really because of the team that's building it and their experience with extremely high performance systems. When you are at one of the main high frequency trading shops, every microsecond means money. And these are the firms that optimize literally everything down to the microwave towers to send signals between cities faster than fiber optic cables, because you don't have to slow down for the curvature of the earth. Literally, that's the level of optimization that they get down to. And the lead of the Firedancer project, his name is Kevin Bowers. He's the chief scientist at Jump. And he is absolutely phenomenal. He's one of maybe a handful of people in the world who are qualified to build something like this. And they have done optimizations on SHA-256 hashes as a part of this process, right? They're rewriting everything from the bottom up in the highest performance way possible. And at the end of the day, I think performance is going to be one of the key metrics that decides where do developers want to deploy their applications and where do users want to interact, and what platforms do users want to use. And this team is just so uniquely qualified to build the most performant system. I don't think there's anyone else in crypto that's even remotely close.
I love that, and I would kind of love to kind of peel back the layers on what you think they're going to do with all of this processing power, because, you kind of mentioned DePin as a sector. Any other sectors that people kind of mention? Are we talking about gaming? Are we talking about NFTs? Like, what's getting people most excited here?
I think the main things to be excited about are going to be payments, DePin, and gaming as first horizon things. And then as a second horizon thing, I'm quite excited about DeFi. But I think we need to get more users on chain before DeFi really takes off. And that's why I'm specifically very excited about payments, gaming, and DePin, because I think it brings new users to these ecosystems. And you really need a scalable system that you're not going to run into some bottlenecks, where the fees are predictable. Visa actually called us out. They wrote a great post about why they're building on Solana, and they talked about the predictability of fees. The problem with some other systems is the fees can spike randomly because something else was happening on the network at that time. Let's say a big NFT mint or something else happened that congested the network, and that will spike your fees, even though I'm just sending you a payment and I'm not trying to participate in the NFT mint. Solana, because of the way that it has parallel processing of transactions, mitigates that fee volatility, and predictability is absolutely essential if you want to do something at the scale that a company like Visa would.
So I'm curious, I'd love to double click on the payments one there. So Venmo, I guess if you're in the US, or maybe Revolut or Monzo, perhaps if you're in Europe, is how people would send £5, £5 to friends very, very quickly. Sling.money is an example in the Solana ecosystem, which I think is doing interesting work. I'm curious how confident you are that they're going to be able to grow the user base and move people away from Venmo, which is free, to something that is on chain, which is at the moment subsidized, but at some point we might have to charge for it.
I think there are some attributes of on-chain payments which are the killer attributes. The biggest things are, one, cost. There is no competing with Solana payments on cost. Yes, if you send a payment from one Venmo user to another Venmo user as retail users, it costs nothing. But if you're trying to do merchant payments, or you're trying to send money internationally, or you're trying to send money from a Venmo user to a Revolut user, there's going to be some cost associated there, or there's going to be some major delay as you're going through the ACH process or something, and that just takes time. So cost and speed are absolutely critical components here. I think that payments will naturally gravitate towards the fastest and cheapest systems. And then last but not least are settlement guarantees. If I'm a merchant accepting payments on a blockchain, I have better settlement guarantees than I do accepting payments through other traditional methods. And that can show up with lower prices for the customers of those products. Because look, there's no such thing as a free lunch. If you're giving merchants worse settlement guarantees, that cost is going to show up somewhere in the system. And at the end of the day, the customer pays. So I'm quite excited to see those cost savings come down to end customers.
Very cool. And I'm curious, has the Solana team or Sling.Money team looked into kind of Southeast Asia from a payments perspective? And the reason I ask that is that we often hear around USDT and people using USDT to transfer funds, and that there are small retailers in Southeast Asia that are using it as a means of exchange. Is that an ecosystem or a geography that is potentially attractive for this use case?
Absolutely. I think it's hard sometimes for us living here in the US or Western Europe to understand what financial services products people in developing countries really want. And what they really want is they want to get dollars because they cannot get dollar-denominated bank accounts in their jurisdictions. So that's why, things like Tether or USDC are quite popular there. I think Tether is a little more popular in those parts of the world than USDC, but we'll see how that develops. And I think that's the first best use case. I think blockchains do help distribute dollars to people in the rest of the world, whether their governments want their citizens to have dollars or not. If you ask most people around the world, what is the currency that they would prefer to use? It's not their local currency. It's not Bitcoin. It's the US dollar. And I think that blockchains are the best distribution mechanism for the US dollar going into the 21st century.
I would love to kind of dive into the valuation framework for Solana, because we've seen a couple of people publish on this recently. VanEck has a valuation framework that it's making its way through the institutional community, for example. But also we saw this comparison between like Solana to L2s on Ethereum that Bankless is doing. So how are you thinking about this at the moment?
This is a great question. I hope you'll bear with me because I have thought about this quite a bit. And I have a framework I think is useful. Before I get into the framework, I just want to talk about metrics that matter and metrics that don't matter. And I specifically want to call out two metrics that I see used that I think are actively harmful. I think looking at TVL, or total value locked, is an actively harmful metric in a valuation framework, because it is too easy to game that metric. Those same assets get counted multiple times. They get redeposited, in one protocol and the next protocol and the next protocol. And I think TVL is giving you a false sense of precision if you're using it in a valuation framework. I also think number of active addresses is a absolutely horrible metric to be using, because it's trivial to Sybil attack that metric. And that means that you can fake it with very low cost. And so if capital markets start looking at that metric as a reliable metric for valuations, you will see people gaming that metric. And that makes it not only useless, but actively harmful to look at. So please do not use those two metrics. They are really actively harmful for a valuation framework. So what do I think is an actually useful valuation framework for a layer one blockchain? For something like Solana, I think it is a sum of the parts valuation with three components. Component number one is a commodity component. This is based on how much SOL is burned as a part of transaction fees. Half of all transaction fees on the network are burned, versus how much SOL is issued. This is similar to how a lot of people look at Ethereum from a commodity perspective, given they look at how much ETH is issued versus burned in transaction fees. The second component is a cash flow component. There is an aspect of these blockchains called MEV, or maximal extractable value. And what that means is if you are an arbitrager trying to do some sort of trade on a blockchain, you are in competition against all of the other arbitrageurs to do that trade. And whoever pays the validator the highest fee is going to get their transaction included first. And so that cash flow that these arbitrageurs are paying to validators, which then gets passed through to stakers in that layer one blockchain, is a cash flow component to valuation. You can do a projection of what you think future MEV cash flows will be on a layer one chain. You can discount them back to come up with a DCF valuation for that component of the valuation of the layer one chain. And then last, but certainly not least, is the money component of the valuation of a layer one chain. I believe that the thing that will be used as money in the information age is going to be the asset that the most people own and use. We all know about, the fiscal and monetary situation that the US government is in, and other governments around the world, have similar issues. I'm not a macro expert, but the situation seems quite dire. And there is a real chance that the thing that is used as money in the world changes into the information age compared to the industrial age assets we call money today. And I think the asset that has the best chance of gaining that monetary premium is the asset that is used and held by the most people. And I think that asset will be a layer one asset of the most used blockchain, which Solana has a very good shot at becoming the most used layer one blockchain out there.
So I really like that. I had a professor back in college who used to tell a joke, which was, someone drops his keys and he drops near the door, but he's his wife comes over and is like, well, why are you looking in the kitchen for your keys? Like, the light's better here. And I feel like that's kind of the nature of like TVL and some of these metrics, because it's widely used inside the industry because it's easier, because people track it, because you can find information for it. But like you said, I don't think it's always like the best thing that people use. It's tough though. I feel like it's a chicken and the egg situation. A lot of people use it, so you feel like you need to actually pay attention to it, and I think you should. But it shouldn't be the main metric that people rely on. I think it's kind of your point. But to the last thing you kind of mentioned, it sounds like you're pretty skeptical about making a comparison between Solana or any L1 with layer twos on Ethereum, for example. Could you kind of just talk us through that thinking?
Oh, I'm happy to compare with layer twos. Layer twos are much more straightforward to value, right? Because it's just another like exchange, basically. Right? What is the difference between depositing my tokens to Base versus Coinbase? What's the actual difference? It's the same trust assumptions to a great extent. Yes, theoretically, Base gives you better exit guarantees, but if there is a lot of usage on the layer two, you're not going to be able to exit to the layer one without paying exorbitant amount of fees, because if everyone is trying to exit layer two all at once, Ethereum L1 is going to get enormously crowded, and that's where you're paying, $1,000 trade fees and such on the L1, which is just economically untenable. So I don't necessarily think that L2s have practically better exit guarantees. They don't have practically better censorship resistance guarantees. They don't have practically better credible neutrality guarantees. So I just see them as, another exchange or another, centralized business built on top of the blockchain ecosystem. And look, those businesses are good businesses. Like, I'm a fan of Coinbase as a business, or there's a lot of good businesses in the blockchain industry, but like, these are not layer one assets. They don't offer the same type of credible neutrality, the same type of decentralization. They don't offer the same type of trust guarantees or anything like that. All of these rollups are, single sequencer. You're relying on a single party to sequence your transactions. And yes, theoretically, there are plans to decentralize a sequencer, but quite frankly, I don't believe them that they will be able to deliver the performance that they want with decentralized sequencers. because at that point, you're just building a brand new blockchain if you're rotating sequencers. So I'm quite skeptical of L2s as a good user experience solution. I think users don't want to deal with switching their wallet from Base to Arbitrum to OP to Polygon. They don't want to deal with bridged assets. They don't want to deal with any of this complexity. They just want simple, cheap, fast, and that's it. And so that's why I'm much more excited about L1 assets than I am about L2 assets.
But then does that push you into like monolithic chains rather than modular chains, which seems to be where the industry is going, right? We have the launch of Celestia, for example, people talking about data availability there. If you're kind of locked into an L1, like Solana, for example, are you then kind of stuck on that one ecosystem and relying on everything, like relying on that for like settlement, execution, everything, compared to say what's going on Ethereum and how it's developing into more of a modular kind of blockchain?
So first, I think the framing of monolithic versus modular is not correct. I would reframe it as integrated versus modular. And when you look at the history of computing, integrated systems often offer a better user experience and a better developer experience than modular systems. Let's look at the last big trend that we had as a technology industry, which is mobile. We have Android as the modular system, and we have iOS as the integrated system. I think it is clear that iOS has a much better user experience, a decade in, than Android does. And it has a better developer experience than Android does. Android's main advantage is that it's cheaper. But in the case of blockchains, I actually see the integrated systems as being cheaper to transact on. And we have plenty of data, showing that they are, just significantly less expensive. So yes, I do think an integrated system makes more sense because I think it is a better developer experience and a better user experience than a fragmented modular system where you have to stitch all these pieces together.
So in terms of the integrated versus modular there, where are some of the weaknesses, perhaps? If you look at Solana, you maybe look to the past where there's been a few times where the network has gone down. Now, many of those, I think, are being solved now, and we've got redundancy, et cetera. But what are some of the weaknesses that you see of an integrated system where maybe a structure more similar to some of the other L1s might be better?
Yeah, there are trade-offs. There's always trade-offs. And when you're operating at the efficient frontier on emerging technologies, there's no way to get a free lunch. You're always trading something off. I want to first address the network stability question that you brought up about Solana. And yes, in the past, Solana has had a handful of network outages, though none recently. And I think that there have been several changes that make future network outages far less likely. Those major changes are four changes. One is a thing called Quick, which is a data transfer protocol, actually originally developed at Google and open sourced, which is gives better performance and reliability guarantees for a network like Solana compared to UDP. So that's helpful. Second is priority fee markets. So what that means is if, Ben, you and I are both trying to do the same trade, we can increase the fee that each of us is paying trying to do the trade first. But if Josh is trying to send a transaction to Greg at the same time, we are not increasing his fee or crowding him out of the chain. And that helps because people don't spam the same transaction over and over and over again. And third, we have stake-weighted quality of service guarantees. So if you are a validator with, say 1% of the network stake to you, then all of the other validators reserve 1% of their bandwidth for you to message them. And that, once again, helps with crowding out and someone just hitting the network with 100 gigabits per second of transactions. And then last, and probably most important, is validator client diversity. With Firedancer hitting mainnet, hopefully next year, I think what we will see is a client diversity, which means that it's incredibly unlikely the same bug is repeated in the Solana Labs Rust-based validator client versus the Firedancer C++ client. And the way I expect most validators to run is that they will run the Firedancer client as their primary and fail over to the Solana Labs Rust-based client in the case that the Firedancer client goes down. And that level of redundancy, I think, will help substantially with network stability and reliability. If we look back at the history of blockchains, when blockchains are brand new, it's expected that they will have issues. ETH had issues early on. There were the Shanghai DDoS attacks back in, I think, 2016, when the network was something like a year old-ish, right? Where, sure, the network didn't technically go down because it's a proof of work network. And, what does it mean for a proof of work network to go down? You can just say it's an exceptionally long time between blocks, right? But the network was basically unusable during that time. And that's okay. Like, these are new systems. And to expect a new system to just be perfect out of the box and never need any improvements is just, it's nonsensical. And don't let perfect be the enemy of good enough.
Thanks so much, Tushar. I think there's like 1,000 other things we can talk about when we're talking about the Solana ecosystem, because we haven't even talked about Solang yet, which allows people to, build with like writing code in Solidity and kind of start taking mindshare away from Ethereum a little bit. We haven't talked about Solstice, but I kind of want to just pivot the conversation a little bit, because one thing I want to address is we've seen already a big run up in terms of the price for Sol tokens, and in some ways, it seems like a lot of that good news has gotten priced in very quickly. And I don't think that means long-term, the prospects aren't still going to be higher for Solana. But, the challenge I find is there's still an overhang of FTX. They're talking about, liquidations of those tokens, short-term, like we've already seen a lot of shorts getting liquidated. So what does this all mean right now in terms of the short-term price action?
I might not be the right guy to talk about short-term price action. Look, our strategy very much focuses on outperforming across market cycles, not within market cycles. And, I have no idea what prices are going to do in the next week or the next month. And honestly, I don't even try to predict that or guess. I don't think I have an edge in doing that. So I can answer the question with a longer-term time horizon, which is, I think Solana will be more valuable than Ethereum. I think that the scaling plan that Solana has is a lot more credible. I think that the developer experience and the user experience on an integrated system like Solana is far superior than it is on a fragmented modular system like Ethereum. And I think the market is slowly coming to that realization. So over the long term, I think Solana is more valuable than Ethereum. And that's what I'm excited about. With regards to your question about, the FTX estate and the amount of SOL that they have, clearly we have seen them already be active in the markets. If you follow, their activities on chain, you can see that they have already been reasonably active as a part of this run up. I do expect that there will be OTC bidders for the locked SOL as well. And here's the thing about an overhang. When everyone in the market knows that an overhang is there, you don't have an edge in predicting how that overhang is going to play out, right? Focus on where you actually have an edge. And there's no information asymmetry here. Everyone in the market knows about these tokens. Everyone in the market knows that the estate is going to need to sell tokens. So what I think is actually a better thing to focus on over a longer term time horizon is what happens after those tokens are sold. It's pretty much guaranteed those tokens are going to be sold. But if you extend your time horizon and look at what happens afterwards, once that overhang is cleared, I think that is a more interesting thing to focus on. And it's a place where traders or investors can have more of an edge in determining a thesis than trying to predict, how will the prices move over the next 2 weeks because of the estate selling tokens or not selling tokens. Like that's incredibly difficult.
At the top of the show, you mentioned DePin. That's a sector which I personally get very excited about, and I've mentioned it a few times on the podcast already. Do you mind just kind of giving us a bit of a summary of maybe one of your favorite projects within that space and why you think it's going to be successful, and maybe lastly just why these projects are uniquely positioned to be successful within crypto and Solana?
Yeah, let me kind of zoom out and talk about this philosophically for a second. At their core, blockchains are a coordination technology. What they enable is distrusting people to coordinate with each other to create something of some value. That's true across the board of all blockchains. Historically, when we have built infrastructure as a civilization, let's look at telecom as an example. The way that we have coordinated the construction of that infrastructure has been through corporations. Giant, multinational corporations that basically are centrally coordinated, and they tell people where to go, what to deploy, and what to do. And they're somewhat responsive to market forces, but it's not a totally free market. Where that radio tower goes is subject to a lot of constraints and the central planning of an AT&T or a Verizon or Telefonica or whoever, right? And centralized planning, I think, is inherently worse than markets. I think the best way to allocate capital is markets. So let's bring these two thoughts together. Let's look at blockchains as a coordination technology that create incentives and allow people to respond to those incentives. And then let's look at capital allocation for a network like a telecom network. And I think that the future of telecom is one where distrusting parties that aren't employed by the same corporation, don't necessarily know each other, don't necessarily talk to each other, can deploy infrastructure for the same network that can be used by anyone. And I think that a blockchain-based protocol serves as the coordination mechanism for those people to deploy the infrastructure and for the users to use that infrastructure. There is, one large attempt at this happening right now with a protocol called Helium, which, as a disclosure, we are investors in, and we own the token there. So that is something that I'm excited and keeping an eye on. But more broadly, I'm just excited about the thesis of distrusting people being able to coordinate the deployment of valuable infrastructure at a scale that corporations simply cannot match. I think that the largest networks will be these decentralized networks rather than these corporate, centrally planned type networks.
Interesting. And narrowing in on just Helium there for a second. So they, I guess, were one of the darlings maybe of the 21-22 period, had a big move up and perhaps have struggled a little bit more recently. I guess I'm curious how you think, are they going to be able to win back the trust of the community? Because as you said, you need to incentivize people, and I think you're 100% right. But do you think with some of the pain perhaps that people have felt there, it's going to be hard for them to win back some of that trust?
I think Helium is very much out of the tell me phase, and they're very much in the show me phase. And the thing that matters here is revenue flowing through the network. That's going to be the only metric that really matters. Honestly, I don't think that there is anything that the Helium team or community can say that matters, that people are going to take seriously to change their minds on the project. I think that the only thing that is going to change people's minds on the project is going to be customers paying money for connectivity through the Helium network, whether that is IoT connectivity or mobile connectivity for your mobile device. I think the only thing that matters is seeing that revenue flow over the network. And the really nice thing is it's all on chain, so you can track it in real time. The era of waiting for quarterly reports to be filed is over, right? Like that's a very industrial age concept. I have to wait until the end of the quarter to see how the company is doing. I think that the future is real-time reporting, and you can see that with Helium's data on chain on Solana today in real time.
Yeah, I certainly agree. I love the idea that people can spin up dashboards on June or similar platforms and get real-time balance sheets or kind of cash flows for all of these projects across the entire space. And also, full disclosure, also an investor in the Helium token. So, Tushar, I just want to kind of wrap up here before we move on to other parts of the show, but we'd love you to stay with us. I guess what is one thing that you believe in crypto that perhaps would surprise people or others don't believe?
Oh, I have so many things that I believe that others don't believe. I think the most important thing that I believe that might be a controversial view is what I was talking about earlier about what will be internet native money. And I think internet native money is the asset that the most people own and use. And will internet native money monopolize all money? No, right? Like I don't think it's going to have 100% market share. Even the US dollar at the peak of US hegemony did not have 100% market share of global money. So I don't see that as the case for internet native money either. But I do think when you're talking about transactions in the metaverse, when you're talking about machine-to-machine payments, when you're talking about international transactions, when you're talking about decentralized finance transactions or other types of coordination, I think the money in those transactions will not be fiat currency. It will not be something like Bitcoin or ETH, which would simply fall over with that amount of transaction demand. It becomes, it's when you have $1,000 transaction fee, that's a liveness failure, in my opinion, right? Like that's not an acceptable threshold. So I think the asset that is used and held by the most people will be internet native money. And I think that monetary premium is the big mega prize that various crypto networks are competing to win.
Very cool. Thank you very much, Tushar. That was a incredibly interesting conversation and went pretty deep in various parts there. So I appreciate you joining us.
Absolutely. Thanks for having me.
Josh, moving to the news. What have you been keeping an eye on this week?
Yep. Thanks, Ben. Tough act to follow always, the market update after our stellar guest, but I will try. So looking at last week's price action, crypto enjoyed another week in the green with BTC up 1.7%, ETH up 5.7%. It's really a sea of green out there. And to my knowledge, actually all top 15 crypto market cap assets demonstrated positive gains in truly a rising tide lifting all boats higher market view. In addition to the well-flagged ETF story, risk assets in general last week performed well with the S&P ending the week up 6%. I think in its strongest weekly performance year to date. This outperformance coming even in the face of poor earnings and the expectation for lower top-line growth in Q4. Yields across the entire treasury curve lowered with the 10-year trading closer to 4.65%, down from what was a remarkable 4.9% to end October. So with rate hike probabilities for December looking at sub 10% now, down from 27% the week prior, crypto also looks to be enjoying the risk asset bid that we're seeing across markets, generally speaking. Turning back to the focus on our markets, while activity and general exuberance has returned for the time being, Kaiko did run an interesting research report update yesterday that said that an Alameda liquidity gap continues to persist 1 year following FTX's fall. This is obviously a big story that clients have asked us about, but we are noting that market depth across BTC, ETH, and popular alts has set to decline by about 55% since last year. So these moves higher look to at least partially be explained by thinner order books. Looking at funding rates, both BTC and ETH are coming off their weekly highs from greater than 23% in BTC and 33% in ETH. But I'm sure Greg has more to comment on positioning and how leverage might be impacting price action. So, Greg, if you have thoughts there.
Yeah, so I mean, leverage, we're definitely seeing more enter the space. Funding rates, more or less across the board, have gone up from relatively low levels to, now we're seeing well north of 10% in many tokens, even the majors. Positioning, particularly in the term futures markets, has also flipped in ETH. For those that have listened to the show before, you know that we've talked about the fact that it looked like the market was short ETH for a number of weeks, kind of through September and early October. And the reason we thought that was one, perp funding rates were relatively low, and also in the term futures market, the front month contract was actually trading below spot, which meant that people were paying up to get short. And at the time, it made a lot of sense. Transaction activity on ETH was declining. And, with rates near 5%, where they were at the time, being short kind of super long duration assets made some sense. We've since seen that flip. Term futures basis is now, about 15% annualized in the front month. So it looks like those shorts have been cleared out. We're seeing similar things in the perp futures markets. Funding rates there are now north of 10, 11, even 12%.
Cool.
Perfect. Thanks, Greg. Josh, I'm curious, just on your point around liquidity and the kind of the Alameda gap. Personally, I'd probably put some of that down to the lack of clarity in regulation. And we've seen a number of market makers leave the space. And even those that are still here, the number of tokens they trade has been reduced pretty significantly. Do you think that was also playing a part?
Yeah, I definitely do. I mean, I do think so. I guess in some sense, everything is kind of related to the downfall in a post-FTX world. I think we have noticed that prominent market makers, big ones that used to quote across various different assets, much extending beyond BTC and ETH, are no longer willing to quote certain assets because of a lack of regulatory clarity that you're mentioning. And that probably is, of course, also contributing to the lack of liquidity in general. I do think order books, though, if we were to probably look at BTC and ETH even, I would expect that those order books would also be thinner than a year ago.
Yeah, I think that makes sense. I mean, I think a lot of the retail also aren't here, and it's just generally a much quieter space. But that will change. We've got 2024 will be our year. Let's hope. What else have you been looking at on the news side of things?
Yeah. So moving on to some large movers, I think we continue to see some strong price action here in major alt L1 tokens, including AVAX, Cardano, and of course Solana, which we just spent a lot of time talking about. The idea here really just being that in a thawing crypto winter, higher beta, riskier crypto assets could see a strong price run, especially given the depressed base levels from which we're beginning from. Looking at BTC dominance, though, at 52.5%, while it's still lower than the highs of 54% that I think we talked about earlier here in October, it is still much higher than the sub 40% dominance observed to start the year. So a bullish take could be that the re-rating in alt crypto assets still has plenty of legs to run on. To note a couple of specific movers, we see that Ripple is moving up 17.4% in the last week. On CBDC headlines that Ripple is collaborating with the National Bank of Georgia as it explores CBDC use within the country. There were some other headlines related to a Ripple IPO, as well as bullish takes on Ripple's ongoing lawsuit with the SEC. These only seem to be contributing to the higher momentum in the name. And in NFT beneficiaries, Blur was trading a remarkable up 47% on the week. It was up 34% yesterday. Even as headlines related to OpenSea cutting jobs hit the tape last week. Nansen reported an increase in NFT sales with Blur having the most trading volume in the last month. I believe it was something like 3 times actually as much as OpenSea. Still, NFT floor prices have plenty to move, with the Bored Ape Yacht Club floor price at 28 ETH, still substantially lower than the 69 ETH at the beginning of the year. I know Greg has done also some work here on Blur and NFTs. If you want to share what you've seen, Greg?
Yeah, let's also bring Tushar back if we can, because I think he may have some comments here.
Yeah, happy to chime in. I think Blur is really an interesting case study on one of my more controversial beliefs in crypto. I think that blockchains are great at destroying margins, and they create more consumer surplus, and they absolutely wreck margins. And I celebrate this. I think this is a good thing. I think we should be trying to create more consumer surplus and make things less expensive. And what we see with Blur is that they destroyed OpenSea's margins. Basically, they came in, they charge far less, basically nothing, and that has caused everyone to need to lower their fees. And this is a great chart showing that compression in margins. And even in a bull market, I don't see a way that those fees go back up in percentage terms, because that seal's been broken. And so that's something that we also really focus on when we're looking at our investments is, will the open source and permissionless nature of the crypto industry allow for defensible margins in this sector or not? And I think it's really easy to look at, something like OpenSea's revenues in 21 and 22 and be really excited about it. But it's very clear now, we have the data showing that those margins were not sustainable. And honestly, they're likely never going back to where they were. We just saw this also play out on Solana with Magic Eden and Tensor. Same exact story. Magic Eden was dominant. People were quite excited about it. And then Tensor came in and just crushed those margins.
Yeah, it's completely agree with that take. We were actually speaking to some traders yesterday about the Blur price action, on the back of OpenSea's layoffs. Initially, we thought it was a little strange, but the take was very similar to one you just described, and that the market feels that now, Blur is going to continue to build on the momentum that they have, continue to take market share. Fees, won't go back up, but because they have this token, they're able to otherwise incentivize users and artists. So, certainly interesting to watch the price action, and we'll have to see if it continues.
Thank you for that, Tushar. Thanks, Greg. And just to round us out with 2 more movers, there were a range of movers, like I said earlier, but Pancake Swap was up 90%. Immutable was also up 24%. So crypto is definitely enjoying a moment here, and it's fascinating to see the price action in some of these tokens. With that, back to you, Ben.
Cool. Thank you very much, Josh. David, quick rundown on macro, please.
Yeah, I'll keep it brief. So basically, I think the big news is U.S. 10-year yields are drifting back lower. That follows the U.S. Treasury's refunding announcement last week. I think that was, of course, more relevant than the FOMC meeting itself, where I didn't see the Fed really make any major comments. But we also saw the first downside miss on non-farm payrolls. That was a pretty big deal. As a result, I think stocks are making recovery right now. Treasury yields falling back. Today, I would say the Federal Reserve's Senior Loan Officer Opinion Survey was probably one of the biggest releases. It's interesting because what we're seeing there right now is bank lending conditions are tightening. It doesn't seem that demand for the credit among consumers is also very high. All this kind of suggests that there's a lot of growth risks going forward. So I think that's going to weigh on sentiment in the fourth quarter of 2023. And probably going into 2024, I think we're going to start seeing a lot softer economic conditions.
Got it. Thanks. Thank you, David. Is there anything that we should be keeping an eye out for just between now and the end of the year?
Yeah, it's going to be the same kind of back and forth between like hard economic data and soft economic data. I think for my mind, looking at the labor market is going to be hugely important, and that comes in the form of like initial claims, for example, or other things. But I do think that the pace of wage increases has already started slow. I think hiring has peaked. Given this new information with regards to kind of lending conditions, or I guess it's not so new because we've seen rise commercial like loan defaults, a lot more dysfunction in that market. I think that what I'm looking out for is how is this going to impact the banking sector? What's that going to do as far as people looking for alternatives? I think that puts Bitcoin as an attractive safe haven bet, for example. So that's what I'd be looking for in the few months ahead.
Got it. Thank you very much, David. And rounding us out for today, Sid, what have you been focusing on in the Web3 space this week?
Yeah, similar to kind of the broader crypto market, DeFi and Web3 have kind of seen a bit of a resurgence both in asset values and also new protocols launching. So this week saw the launch of a new project called Prisma Finance, which is kind of a decentralized borrowing protocol where folks can generate a stable coin called MKUSD, and it's collateralized by liquid staked Ether. So various flavors of LSTs like wrapped staked Ether, Rocket Pool Ether, and Coinbase staked Ether. The protocol is kind of ballooned to over $350 million in assets locked over the past week, with a key $110 million deposit coming in from one address that appears to be linked to Justin Sun. And seeing quite a lot of traction. Is linked to the Curve teams as well. And we will see, I think there's been an increase in minting overall of liquid staked Ether over this past week on the back of Prisma. And related to borrowing protocols, we also saw another piece of news from Aave, where there seemed to have been a kind of issue that was reported to the team, and on November 4th, the Guardian, which is a 6 of 10 multisig for Aave, basically took an action to pause the Aave V2 Ethereum market, and then also certain assets on Aave V2 on Avalanche, and then also a few assets on Aave V3 on Polygon, Arbitrum, and Optimism. And it was kind of termed as a temporary prevention measure. Folks were still able to, withdraw or repay positions, but they just couldn't supply to these markets over the time period. But earlier today, there was a governance proposal passed and to reinstate it to reinstate normal operation for Aave, but it's only going to be implemented in 6 days. So as of now, the pretty large market for wrapped Ether on Aave V2, it's around $400 million, is paused. It remains paused. So that's the scene in Web3.
Interesting. And Sid, do we know what the kind of foundation problem is there at Aave, or has it not really been released?
The full postmortem hasn't really been released. There's just it seems to be an issue with kind of the stable debt mechanism, which is kind of part of the protocol. So I think we're waiting for the full postmortem this week.
Great. And then just running through the first part of your section, you were talking about stable coins that could be minted from LSDs, liquid staking derivatives. What is the collateral requirement for that?
Currently, Prisma is operating at 150%. Significantly more than what's borrowed, and then folks kind of take out vaults on it, where they state a liquidation threshold. And then they also are keeping a safety pool of collateral in case liquidations do happen. So quite a complex system working over there.
Interesting. And how do rates compare versus some of the other decentralized lending platforms for dollars, for example?
Yeah, right now it's a little bit of Yield forming frenzy reminds some folks are commenting reminds them of Wi-Fi in early 2020, just because they've introduced a new governance token, and then they're also tied up with Convex and Curve to have additional LP pools. And with the whole locking mechanism, the longer you lock the token, the more you get yields and so on and so forth, with locking ranging from 26 weeks to 52 weeks. So, it's kind of a yield game there. The yields range anywhere from 16 to 50% right now, but obviously we'll see that drop slowly over time.
Perfect, thanks. And Tushar, we'd just love to bring you in for the last comment here. So we spoke about Web3 DeFi here, and we do end up focusing a lot on Ethereum, but we want to make sure this is fair across kind of all chains. Where is the best place to keep an eye on DeFi on Solana? And is there anything similar to what Sid just discussed happening on Solana right now?
I mean, I think the best place to keep track of activity across most chains is on Dune. So there's a number of really great Dune dashboards that you can take a look at. I would just say, be careful what metrics you look at and try and understand how easy it is for people to game those metrics. There's this old saying, what gets measured gets managed. And, if you're looking at the wrong metrics, it can be really detrimental. So the general framework that I like to use is look for metrics that have a real cost to fake. So an example would be transaction fees paid, or something like tokens burned, or something like that, where there's an actual cost being paid.
I love it. We've got our takeaways, Tushar. We know what our homework is. Cool. Well, that's thank you for that, Sid. Thank you, Tushar. Thank you, Greg and David and Josh. That's a wrap for this week. Thank you for joining, and we will see you next week. Take care.